Welcome to what will be the final video of the next few months, as I do every year, taking a summer hiatus from the Friday videos. But I want to leave you with the 5 main drivers of market performance for the next few months. Let's jump right in. Far and away, the most important variable impacting the market is earnings growth. This is the percent increase in a company's profitability. And when people ask, how on earth is it that the market's higher despite oil prices, Iran, and everything else going on? The short answer is that earnings growth has been exceptionally strong. What we see is that trailing 12 months earnings per share have increased by 19% year over year, and projections for Q2 are in the neighborhood of 22% earnings growth. This is an extraordinarily strong number and a sign of robust corporate strength. That earnings growth has helped keep valuations stable, even as the market has reached new all-time highs. This certainly isn't to suggest the market is cheap, but it's just to say that valuations are roughly in line with where they've been over the last several years, despite, again, reaching these new all-time highs, with the S&P currently trading at roughly 20.9 times forward earnings. A potential risk, however, to earnings growth and stable valuations would be a sustained rise in energy prices, which would function like a tax on individuals and businesses, reducing discretionary spending. Fortunately, oil has managed to fend off the calls for $150 a barrel and has been trending lower to currently around $95 a barrel at the time of this recording. Another potential risk to be aware of is the increasing lack of fiscal flexibility. What I mean by that is when a government is operating at a surplus or roughly a balanced budget, if there's a major crisis, they have the leeway to react to that with fiscal policy stimulus. However, when a country is running a massive deficit, adding greatly to the debt, that reduces the policy options available to them. What we see here is that there are a few countries, Norway, Denmark, and Switzerland, that are running budget surpluses, and most of the rest of the developed world running massive deficits, unfortunately, with the United States all the way to the right-hand side here, running a 7.6% of GDP deficit, which is the most among any OECD governments. Our final key to watch is the volatility in interest rates. We've seen 30-year U.S. Treasury yields reach the highest level in the last 2 decades before settling back to roughly 5%. We also saw the 10-year and the 2-year yields rise as well, as expectations that interest rates would stay higher for longer increased, with the market now expecting the Federal Reserve to raise interest rates at least once by the middle of 2027 in response to sustained inflationary pressure. Of course, there are other factors impacting the market as well: policy, geopolitics, AI, and the list goes on. But I would submit the most important factor is the decisions that we make, is our behavior, our response to the news and the headlines that we're bombarded with constantly. And that's where our job comes in, to be hyper-rational in aligning your investments and your financial plan with your goals and objectives. Thanks for watching. Enjoy summer.